definitely I want to thank our sponsors, Approved Mortgage Solutions. Where's Carl? Carl's over there. So these guys are wizards. These guys are everything from financing to real estate needs. Definitely talk to them after the presentation, from creative financing, no credits, no money, no real estate, no nothing. These guys got you. So thank you so much for your support.
Are you on Instagram?
Some of you guys know me that we have a relatively semi-successful podcast where we interview different thought leaders with different executives from President of Microsoft. They came on the show. CEO of Deloitte, Michael was on the show, Austin as well. And throughout these conversations, we discuss a lot of the different trends on what's going on in the real estate, what's going on in the market, financing strategies, what are we staying away from, what are we investing in. And through these conversations, we thought, well, instead of just keeping that to ourselves, let's make that available to everybody else. So that was the idea, to start hosting these events. We do these events monthly. So definitely subscribe, follow us on all of the channels so that you stay up to date on all of the things that are going on with all of these events. And in general, the purpose of these meetups is to make sure that you guys are walking away with new connections, new opportunities, new knowledge. So that's what we're here for. So thank you for coming. And last but not least, want to thank our panelists, our real estate investment experts, for taking the time and share the insights with us today, Austin and Michael. And I'll give you guys an opportunity, maybe do a quick self-introduction. Michael, I'll pick on you.
Sure.
Maybe a quick thumbnail version of your career. And
thank you for inviting me. My name is Michael Merino. I am a local attorney. I'm a board certified real estate attorney. Been practicing, more than 25 years, a long time. And I have seen everything, I think, over the last 25 years or so in this market. And I do real estate, I do corporate work, business law, I do digital assets, syndications, tokenization. We do estate planning, trusts, offshore planning, asset protection. Pretty much anything that I don't do, I usually know somebody in the community that.
So that will give you guys an opportunity to ask some questions as well. So definitely do that. So Austin, let me start out from your perspective. With such a massive social media following, you follow a lot of the different trends. You're on top of a lot of the things that are going on in real estate and just the investment world in general. What are you making? What kind of sense are you making from the current real estate market? Is it still making financial sense to invest? Maybe share some insights from just your overall perspectives on the current situation.
Yeah, no, absolutely. There's a lot of fear in the marketplace is what I'm seeing right now. It's the foreclosures are coming, interest rates are going up, banks are collapsing, all these negative things. The thing you got to understand is there's opportunity in every negative, right? Money doesn't just disappear, money changes hands, right? So you just got to find a way to be on the receiving end of those things. So there are some asset classes that people are being cautious of, including myself. I'm not doing high-end, flips right now personally. It's just I don't like the risk with it. I'm not doing super long-term projects right now. Again, don't like the risk with it. Ideally, we can get in and out of deals in 90 to max 180 days, and hopefully keep the renovation budget under $50,000. The biggest thing you got to understand is that there's opportunity that comes in any market, no matter what it is. You just got to be able to adjust. So being able to raise private money, understanding subject to. I've never done a subject to deal. I did my first one like 4 months ago because that's where the market's headed. So you got to be able to learn and pivot and adjust, and there'll be opportunity in any market.
Yeah, that makes a lot of sense, Austin, and especially from the flipping side with the market shifts. What we've seen for the past couple of years has definitely been an anomaly. So yeah. At the end of the day, if it fits your investment thesis, invest in that. But that makes a lot of sense. Austin, you mentioned from the rate hikes and all of the things that we've seen from the Fed, last couple of months, I guess. Michael, from a standpoint of just a lot of the noise around the interest rate hikes, with the recent 1 point, almost a quarter of a percentage that was raised, and the federal fund rate right now is at 4.75 to 5, mm-hmm. And I understand that it's a 10th consecutive interest rate hike. Which has been, probably historically the longest streak as far as raising the interest rates. What does that mean for average, regular real estate investors like us? Maybe talk a little bit further from, what are you seeing in the market that would impact as far as the valuations or maybe the ability to finance or find new deals? Just overall share your perspective from just the interest rate hikes perspective.
Well, I mean, definitely the interest rates have made things much more difficult. But as Austin said, with every negative, I mean, there's opportunities. I mean, I for one have advised a lot of my clients to look for seller financing type deals. Also, assumptions. And I think a lot of people have forgotten about assumptions. And if you think about the last 3 or 4 years, rates were very low, prior to the rate hike. So I mean, if you can find somebody who in the residential space or the commercial space that purchased something at a low rate that could potentially be assumable, that's something to look at. I mean, that's an opportunity. But certainly the interest rate hikes have put a sort of a damper on everything. I mean, everything is for a while there. About November is when about maybe late October, November, I started to see just kind of it was like a wall. Like we hit a wall. And everything sort of stopped, at least in my practice and a lot of the attorneys that I've spoken to. And it's now I think people are coming to the realization that the rates are what they are, the prices are what they are, and at least in South Florida, I think people are also realizing that because of supply and demand and the low inventory that we still have, and the external factors in this market, that we're a market that's unlike pretty much any other market in the U.S. I mean, you look at markets like Phoenix or out west. I mean, those are markets that are going to be impacted. They're going to see decreases in pricing. So far here in South Florida, it doesn't look like it. I mean, we have people that come from South America. We have people that come from Canada, from Europe. We have people coming from New York. We have people coming from Columbus, Ohio. So we have a lot of that, and we have the no state income tax. We have great asset protection here. We have some of the best homestead laws in the United States, and I'm bullish on the South Florida market because of all of those reasons. And again, like anything else, I don't pay attention to the market. I look at whatever market you're in, you just got to find the deals and you buy low. And there's always somebody out there that needs to sell, that needs to get out, and you just got to I think the trick is to learn how to harvest, how to find those deals, and there's a variety of different avenues and ways that you can do that. But it's anybody's guess what's ultimately going to happen over the course of the next year. I mean, certainly the bank crisis hasn't helped. I was talking to Austin before we got on, and that in the last 10 days there was about $110 billion was taken out of small and regional banks. And a lot of it shifted to the big banks, and so what that does to the small and community banks, remains to be seen. So there remains a lot of uncertainty, but I still think a lot of opportunity.
As they say, you marry the house, you don't marry the rate. And at the end of the day, it's a trend, it's a cycle.
Right.
So that makes a lot of sense what you're talking about.
Yeah.
And on that note, with rates being so elevated these days, financing becomes a challenge. And creative financing strategies become of utmost importance. So Austin, from your perspective, you're the master of creative financing strategies, different techniques, especially the OPM. Maybe spend a couple of minutes talking about what the OPM strategy is all about. You actually wrote a book about this. So if you could condense that to us in a high-level summary, and how can someone such as an average investor with no brand or no social media following take advantage of a strategy as such and implement it if they wanted to invest into real estate using the OPM?
Yeah, no, absolutely. I love talking private money. We've done 300-400 deals probably. All of it's been funded through OPM, other people's money. First deal, I was 21 years old, raised $250,000 for a $170,000 rehab, $74,000 purchase to do a deal with no experience. So private money can absolutely change the game. The cool thing is when you understand the creative side of things is how do you merge creative strategies together. So the subject to deal that we did, we took it subject to, I think the balance still to be paid was like $70,000. And it was on the 17th year of the mortgage. So we're on the back end, which is good for principal pay down. But we had to pay, the seller wanted to walk with money, and we bought it from a wholesaler, and the wholesaler wanted to walk with money. They wanted a $40,000 assignment fee. So we went to a private money lender, raised $80,000 in gap. So when we took it over subject to, the first lien stayed. We raised private money for the gap of 180 to be all in for 150. And as it stood today, it was worth $190,000. And the seller was going to lease it back for $2,000 a month. And the original mortgage was like $750 a month. And then when I raised the money with the private money, we just did interest only for 5 years, and that payment's about $450 a month. So payment's $1,250, income's $2,000. We get into a deal on the 17th year of a 30-year amortization. So that's how you can get creative and structure deals, but you need to understand private money. So, couple, like 2 or 3 big bullet points that people always ask about money. One, the first thing you got to understand is the mindset. Because when you come into somebody and you asking somebody to invest in you and believe in you, in negotiation, you're down here. It's always harder when you're on the lower level in a negotiation. But you genuinely have to believe you're giving somebody an opportunity of a lifetime to invest with you because you are. Think about this. People that wanted to retire this year or last year or next year, seriously, let's say they had $1 million in an IRA or 401k and they're trying to retire, and the market crashes 30% and their $1 million retirement went to $700,000. You think they're retiring now? No, they're scared as all get out. And they got to work another 5 or 10 years to make that money back. But the people that are invested with me, their million went to 1.1, 1.2, 1.3 million because we're paying an interest rate secured by a real asset of real estate. So I've gotten the phone calls from people crying, thanking me for allowing them to retire early and enjoy the life that they can live in retirement now. So I genuinely believe I'm doing a disservice to everybody by not telling them about the opportunity to invest with me. And it becomes way easier to talk to people about private money. So the first thing you gotta understand is you're genuinely giving somebody an opportunity of a lifetime to invest with you. And then the second thing is like, all right, that sounds great. Well, where do you find this type of money? The answer is everywhere. There's a lot of money in this room right now. There's a lot of money everywhere you go. My first lender, I met in a room just like this a year before borrowing from them. I'm just having a conversation, shaking hands. Hey, what do you do? Say, hey, I just retired. I'm trying to get into real estate. I have this IRA, and I'm going to use that to start real estate. I was like, oh, cool. Me too. Trying to get started, get my first deal. Year later, got that first deal. Needed to raise $250,000. Called everybody I could think of. Her name came to mind. Called her, and I was like, hey, how's it going? She said, well, I'm just still trying to get started. Perfect. You want to invest with me? She let the deal at 12% and 2 points. So you never know where you're going to meet somebody with private money. You literally got to talk to everybody about it. In one intro way, you got to, I like these name tags, right? This is a very good way to how to spark curiosity, because everything in life, you got to find a way to talk to somebody. So if you go up to someone, you ask, what do you do? They say, I'm a doctor. They ask you in return, and you say, oh, I'm trying to get into real estate. Like, oh, cool. And then they move on to the next person. But it's like, how do you get them to be interested in what it is that you have to say? So when I was younger, a lot of times I would say, it's like, hey, people ask me, what do I do? I say, I'm a real estate developer, and I teach other people how to invest their money into real estate. And everybody's not going to, care about that. But one person's going to be like, well, how do you do that? And now your foot's in the door. Now you can have the conversation about investing with you. So those are like 2 huge mindset shifts that you got to understand. I literally talk to every single person I know about private money, and you need to too. And it's because I believe it's an opportunity of a lifetime for them to invest with me, and I'm doing them a disservice. And it's mutually beneficial. Like, we're both winning, but they don't know what they don't know. So I need to tell them about it. Those are 2 big mindset shifts. I could go on and on about private money. I love it, but learn about it, understand it, and start talking to people. Because people say like getting rich is through wholesaling and flipping houses, and that's great. But how do you build real wealth? It's from owning assets long term. And the way you can do that is by using OPM, other people's money, to get into these deals.
Yeah, absolutely. And I like what you mentioned about the mindset, because at the end of the day, as you said, they're not investing into the project. They're not investing into an opportunity. At the end of the day, they're investing into you. So that makes perfect sense. Michael, looking at things from a different...
Somebody with not a lot of money, and the guys I'm thinking of, they got in, I think it was about $20,000 all in. I think it was first, last, and their option payment, and they're doing extremely well. They've had to put a little bit of money into the house to make it nice, but those are a couple examples of opportunities. And again, other people's money, great. Finding lenders, hard money lenders, private lenders that want to make a few bucks, and there's a lot of them out there. Like Austin said, I mean, you'd be surprised. I mean, I have a long list that I've compiled over the years, people that I know, and I always get a lot of people say, hey, if you know somebody who wants to borrow some money, I'm private lending, and so you have a lot, because it's a secure investment for someone. I mean, if I'm lending somebody 60%, 70% of value, and I'm making 12%, and I'm making 2 points, I mean, that's a great deal for the hard money lender to get into. And beyond that, I mean, it's really, again, as I mentioned earlier, is finding the right places to harvest these deals. A lot of people always go to foreclosures or a lot of the seminars and things. And this, you see on late night TV, the guy that is in front of the yacht with 5 supermodels, and he had nothing, and now he's a multimillionaire, and he did it through foreclosures. But that's not the only avenue. It's also probate, customs and treasury auctions. Lists of people that have gotten judgments against them recently, purchasing second mortgages, purchasing second judgments, where you can foreclose on those judgments and force a sale and things like that. I mean, there's a ton of different angles to finding these deals. Most recently, with what's happening in office, also a lot of deals, I think, in repurposing. There's a lot of offices that, especially in the B-type class market, that just are not surviving, and you're probably going to see some foreclosures in that space. And right now in Florida, they just passed a law called the Living Local Law that just, I think it was yesterday or the day before. And what that law does is that it basically streamlines zoning. And if you want to go and put, you want to do affordable housing or workforce housing, your zoning is going to get approved almost always. And according to this new law, they're going to basically allow people to streamline. You're going to be able to put in a warehouse district, for example, where maybe it's all warehouses. You'll be able to put workforce housing there. I mean, because it's a huge problem in Florida. Affordability is just people can't afford to live here. So this law is supposed to open that up, and like with every thing like this that passes, there's opportunities. And that law combined also with Senate Bill 4D, which is the one that the Surfside law, where now used condos, and I think somebody mentioned, what do you want to stay away from? Well, I would probably stay away from used condos right now because of that law, but also opportunities for developers to come in and buy into these buildings, take over the condo, terminate the condo. They're also working on, by the way, a termination law that's going to kind of even the playing field, where developers will be able to come in and buy these older buildings. So a lot of things happening right now that are going to create opportunities, and among them is this zoning law, this condo law, and again, it remains to be seen how it all plays out, but a lot of good opportunities.
Yeah, absolutely. That makes a lot of sense, especially you mentioned a couple of markets. You mentioned Ohio, you mentioned South Florida, and yeah. I pulled some data from Redfin, and surprisingly, well, I don't know if it's surprisingly or not, Florida Tri-County, from the West Palm Beach to Broward to Dade, are the top 5 markets that are actually seeing price increases in Q1 of this year. And other markets such as California and Texas are being crushed,
destroyed,
especially when it comes to San Francisco areas, Austin, Texas, and all of those. So when it comes to markets that you're personally very bullish on, Austin, I want to get your perspective on the areas that you're investing in, and what are some of the factors that go into that decision-making process?
Florida's prices are crazy, if y'all haven't noticed yet. I don't personally invest in South Florida. I own Airbnbs. I love them. I don't like buying Airbnbs if they only work as an Airbnb. Because I had them when COVID hit, and they allowed 12 months of cancellations, and our revenue went to 0. I've heard places here locally, change up city ordinances, and you can no longer Airbnb. So just make sure you have, some sort of multiple exit strategies. But I like the Midwest. It's where I'm from. It's what I know. But the purchase price to cash flow typically makes a lot more sense in those markets. I'm personally in and around central Columbus, Ohio. Cincinnati, Ohio is another great market. I feel like Cincinnati's like 5 years behind Columbus. Columbus got, a $20 billion investment from Intel. Google's there, Facebook's there, Amazon, like everybody's there. They're claiming it's the next Silicon Valley in the Midwest. I wouldn't take it that far. But Midwest, you can actually get real cash flow on regular, like rental, long-term, normal leases. The Indianas, the Ohio's, the Illinois, all those areas, and then the Southeast too. Different parts like Alabama, Tennessee, Georgia, not like the big cities. Like Atlanta's probably getting a little bit priced out at this point. But if you're flipping, you can flip typically in any market as long as you buy the margins correctly. But if you want to own long-term and build wealth, you got to make sure that the cash flow is actually there. People come to me all the time. They're like, "Hey, this is trading at an 8 cap." I'm like, I don't care about the 8 cap. Like, what's the cash flow? Because if the 8 cap's there, but you're negatively cash flowing, like, what's the point? You can't even get it financed because it's at a 0.9 DSCR, and the bank needs a 1.25 DSCR to be able to finance it. So to me, I know that's the values of properties, but they need the cash flow. I will never buy an asset that does not cash flow. We got a deal that we tried to flip, didn't work, tried to rent, didn't work. I could have rented it to break even on a monthly, and then once you add back vacancies and repairs, we 100% would have negatively cash flowed. I sold it at a lost like $20,000, $25,000 because the only reason anybody ever goes bankrupt, there's only one ever, is from lack of cash flow, right? If you're losing $200,000 a month, but you're making $250 in a different business, guess what? You don't go bankrupt. But when you have lack of cash flow, that's the only reason somebody goes bankrupt. So make sure when you're buying these assets that they positively cash flow, because values don't matter at that point. And I'm not saying buy something and hope that the value gets cut in half. Like, that's never the idea. But if values do come down 10, 20, 25%, and you can cash flow it for the next 5 years until those come back, you're going to be all right. Like, you're not going to lose an asset because you still have the cash flow. So I love the Midwest. I love the Southeast. Those are some of my favorite markets.
Yeah, it makes a lot of sense, and I like what you said about
it. And it's sort of still playing out. So it, again, remains to be seen how it will all play out in the end. But that would be one, and used condos in Florida. And again, the used condos in Florida, because of this new law that passed, it used to be that in used condos, they could waive reserves where they wouldn't have to they could kick the can down the road and not deal with the structural issues. And now they're going to have to deal with it. And the problem is that you have a lot of buildings that are, people that are on fixed incomes that, they can't afford these special assessments. So the likelihood is that you're going to see, either a lot of foreclosures in that space, or you're going to see, developers who are going to come in and basically buy out the building. The problem that we have right now is that the way the law is written, you need 95% of the condominium unit owners to do a termination of condominium, which, it's a very high threshold to meet. And also, there's no mechanism like an eminent domain. An eminent domain, if the government takes your property, they have to give you reasonable market value, and there's nothing like that in the statute for condos. So what the legislature's been talking about and trying to come up with is some kind of method to make it a more level playing field so developers can come in and start, buying up these buildings, because you got a building on the beach that's 50, 60 years old and it's deteriorating. It just isn't the highest and best use. So in terms of what to stay away from, probably used condos. Again, unless you're a big developer, it's going to come in and that maybe there's some opportunities there. But there's also, I think that like with what we had started to talk about, I think the big is fear. And I always look at fear sometimes is good. I don't know, Gordon Gekko said greed is good, fear is good, fear is good. So and it's good because in terms of being an investor, is because a lot of these buildings, people, they hear about this law, they hear about, oh my God, condos are going to go, but not every building is bad. I mean, there's a lot of great buildings that are well run. They've gotten their reserves. Their financials are solid. They might be old buildings, but they've been, they're good buildings. And so I think that there are some opportunities there still. You just have to be very careful when you're going to get. If you're somebody who does invest in used condos, you got to pay close attention to the financials, close attention to the reserves. You need to walk the building, see what it looks like. So there's some opportunities there, but also, you got to stay away from some of those buildings because I think they're going to have big problems.
Yeah, no.
And one other thing I wanted to mention, another that I forgot to mention in the opportunities is condo lien foreclosures. Also, a lot of good opportunities there to watch for, where you can get into the game for for very little money. Some of these condo liens are $6,000, $7,000, $8,000. And you can come in and take over a property for very little money. You're going to take it subject to most of the time. Sometimes it's paid off, and you got somebody from Venezuela that died, and You can actually buy it in a condo foreclosure, but some good opportunities there.
Yeah, and I'm yet to see a case study where condo actually make financial sense or any type of sense as an investment asset type.
I'm not a big. I never invest in condos. I just don't like them. I don't like having an association having to. Well, you got to wait 30
Regulate
days
everything.
for them to approve them. I like a property you can stick a sign in the front lawn, and you're not subject to any condo commandos telling you how to do it and when to do it.
That's right, condo commandos. Austin, we briefly touched upon your social media presence and being on top of the different trends. So as far as, marketplaces, fractional ownership, blockchain, VR, crowdfunding, a lot of these different trends have been on the rise, especially last quarter, I want to say, because things are slowing down. People are looking different ways of doing things, selling, investing and stuff like that. What are you personally excited about when it comes to trends? What should we be studying? What should we be watching out for, especially through the next period as we experience what's going on in the markets these days?
Yeah, so as far as fractionalization, crypto things, I don't know that much about it, so I don't want to mislead. You say you get into that a little bit, but as far as trends, warehouse and industrial, everybody I talk to is going through the roof right now. Less people in office, more people ordering stuff online. The need for warehouse and industrial goes through the roof. So there's definitely an asset class that I'm looking at. Multifamily, we were talking about this earlier, so syndication of multifamily, you buy a distressed multifamily asset, you raise money to buy it, you renovate it, you go and you get a new loan once it's stabilized. The problem is over the last 1, 2, 3, maybe 4 years, these people were buying these deals, and like big deals like that, 100 plus units takes 2, 3, 4 years to stabilize and put a new loan on it. They bought them at 2, 3, 4% interest, and now the interest might be at 5, 6, 7, 8%. So the numbers that they ran, their numbers on the interest rates don't. What's the saying, that the math ain't mathin'? So it doesn't make sense. So I've been presented a lot of opportunities from people that were getting old, that wanted to liquidate, that were 45 years old. Obviously, they're not getting old. It's that the deal doesn't make sense. So I don't know how these assets are going to come to the market, whether that's a short sale, whether that's a foreclosure. I'm not 100% how it's going to come, but I do believe it is coming. And I'm on social media. I run with a lot of these big influencers. I don't run with them. I know them. And what you see on social media, don't believe it. There's a lot of people that are talking this big game that I've gotten phone calls, mentors of mine have gotten phone calls to raise more debt to get them out of these types of deals. We're buying a deal here in a couple weeks from somebody that got caught up financially. So it's, in my opinion, the multifamily space is coming. I don't know how it's going to happen, but definitely looking forward to that asset class as well.
Yeah, that makes a lot of sense, especially when it comes to capital, which is a venture capital firm. So we're hosted on a platform called AngelList, and AngelList, all of the banking is done with SVB. So we recently raised the fund, close to $20 million. I'm in Singapore, and we get the news all over the place. Silicon Valley Bank is collapsing. Pulling my hair out, investors are calling, finding out, hey, I just did it. Wire transfer, I'm an anchor LP, $2 million. Money went into Silicon Valley Bank. What's going on? Is everything okay? Long story short, we got all of our money out, and the risk was mitigated with a network of different banks. So that was a little scary. But there's a trend that goes on from just the overall banking sector and the financial institutions and how they run, how they allocate capital, because at the end of the day, that's what led to a lot of the collapse. Jerome Powell himself, he said, look, it's the leadership at the SVB Bank that's at fault to be able to have that freedom and allocate the funds into the assets that were not necessarily, I guess, well due diligence, so to say. What do you make out from this particular situation, and how is that going to impact just the real estate investing market in general?
The short answer. The short answer is I have no idea. But Silicon Valley Bank, I understood because the whole, the crypto winter that we're going through, and they're a tech company. Facebook's laid off people. All the big tech companies out in California have laid off people. I mean, that's one of the areas of the economy of the work, workforce that's being laid off. So I mean, I kind of understood that. The one that I think concerned me more on a global level was Credit Suisse. That you're talking about, one of the oldest banks in the world, Swiss Bank, and theirs I had to do with, I think, CDOs, a lot of collateralized debt obligations and credit swaps and things like that. These fancy products that they had. But I mean, what sort of took me aback a little bit was the news this week that how much money had shifted from these smaller community and regional banks, which they're kind of the workhorse, or they're the ones that provide a lot of the financing, like we were talking about, for a lot of the local developments. And so how that's all going to play out, with that shift. And I mean, all I can see is, a tightening of credit. They're going to have to really now, their underwriting guidelines are probably going to be, much stricter. So again, I like I said, the short answer is I don't know. I can tell you that it's, when you see those types of failures, it's scary, to see that. So again, how it all plays out, remains to be seen.
Right, yeah. Right, absolutely. Last question, and then we'll let you guys ask some questions. So Austin, with just social media presence and building the personal brand, I think it's not at the top of the mind of a lot of investors, but spend a few minutes talking about the importance of that and what are the different strategies that actually do work, because we hear a lot of different ways of stay consistent, post a lot, do all of this stuff. But from your perspective, things that actually do work when it comes to building a genuine presence online and social media, maybe share some of the strategies that all of us can implement.
Absolutely. Social media single-handedly changed my life. If you don't have a social media brand, if you're not building one, you're missing out on a massive, massive, massive opportunity. It's only getting bigger. I say social media exists two ways in the world right now, and there's only two. There's not a third option. It either you use it for a benefit, you go out there, you put content on it, you build a brand, you monetize it, or it uses you. Those are the only two options. And if you're sitting here, well, I don't have social media, it doesn't use me. Well, you're talking to somebody, they're talking about social media, now you're getting used by social media. Those are the only two ways that exist in today's world. So for me, has anybody in here ran ads, paid marketing for any type of business out there? Cool, bunch of people. You gotta pay to get your ad out to people. Social media, they pay you to put your ad in front of other people. So it's a huge opportunity. I've got a ton of deal flow from it. I've got to raise a ton of private money from it. I got into the VC space from it. So it brings a massive, massive opportunity. And I genuinely believe everybody needs to be building a brand, because if you have anything that you're doing to make money, it only adds to it. But as far as specific things on how to grow it, one of the things that when I started out, it was a mental block. It was why do people want to know about Austin? Why does anybody care about anything that I have to do? And somebody told me, hey, you don't have to create, you just have to document what you're already doing. And that lit a light bulb. I was that's easy. We're already doing it. We're calling people, we're making offers, we're looking at houses, we're looking at deals, whatever it is that your business is, we're already in that space. Now just document what you're already doing, right? You'll see on my TikTok and Instagram is deal or no deal. Here's the numbers. Would you do this deal? I already ran the numbers. That's just documenting what I just did. Or when you're out in the field, walking through houses. For me, I don't go to houses anymore. Everything's done remotely. So when people follow me, they don't see me walking through the houses in the trenches, I call it. But when they follow somebody else that's newer in the game, that's still going to houses, meeting sellers, meeting contractors, they're posting the real stuff that people want to see. The only reason I go to properties is to shoot content. I wish, one of my biggest regrets is not building a brand while I was, running job sites, flipping 15 houses at a time, running Lowe's and Home Depots every night to run materials. That people are attracted to that type of stuff. So document, don't create. As you continue to build, you can start creating and create hype videos and all that other stuff, but you definitely don't need that at the beginning. Documentation is huge. And then as far as content, I know some people that post once every 5 days, and I know some people that post, 5 times a day. I've kind of fell on the side of, yes, volume is important, quantity is important, but quality is the same value. So I would rather post once a day or once every other day and have good content than post, 5 times a day and just put up some crap that, nobody really cares about. And the other cool thing with social media is like really there's only one video that really put me on the map with social media. We were sitting in a circle, I was at a mastermind and just clicked. I was like, let's make a video about how many units we own. And I said how many units I owned and the value of the portfolio. And then I went in a circle and between all the guys, it was like 8,000 units and almost $1 billion in assets under management. And you know, the video went dumb viral, like tens and tens and tens of millions of views. And probably half the people that know me today know me from that single video. So, you know, it only takes one to really pop. You know, whatever it is, you can post content consistently. It took me 1.5 years to get monetized on YouTube. You know, it takes time sometimes, but one video can literally change the game. And I mean, I've done many webinars where I've made hundreds or $200,000 in an hour on a webinar from social media. So it's extremely powerful. Love talking about it. You know, definitely happy to answer questions afterwards as well.
Well, that's great, and I know what kind of video we're going to do at the end of this video. We're going to ask everybody what kind of real estate they own. Want to open it up to you guys, ask any questions.
Tax deed auction at some point. Mortgages, because you waive the homestead right, but you know, Florida's got pretty strong asset protection in that regard, and you know, we've got some pretty good corporate laws as well. But the main one is the homestead. That's a big one. If you want to hide money from a creditor, buy a house.
And other states don't have that?
No.
Texas has it, but not many others. Yeah.
No.
But Texas is another one that's got pretty strong homestead laws. But yeah, you know, mostly just those two states are on a lot of them. Yeah. You're welcome.
Question over there at the top.
Thanks. Point of view of your angel list and startup dates. You know, I've heard of triple net leases, where basically you're loaning money for like CPS or someone else to like move on. But is there the opposite of that? Could you partner with a landlord to become equity partners in your business? Like give them a portion of the profits as opposed to just giving them rent every month?
Okay, so let me paraphrase, see if I got your question right. He's asking about the triple net leases and also structuring a deal where you bring in the landlord or the property owner as an equity shareholder when you structure that particular.
To get reduced rent and all that stuff as well.
Yeah, for other commissions. Any of you guys?
I mean, I'm
had
very
experience in
familiar
that?
with triple net leases, but I'm not sure I understand the structure of it. But you know, triple net leases are great, especially for you know, landlords who don't want to be hassled. They would just want to get their check every month. Usually they're good at Popeyes. I think they have you know, and you know, they're great because they're just very low maintenance. But in terms of you know, partnering, I'm not been. I haven't been. I'm not familiar with that. You know, maybe Austin could address it.
I think your question was in relation to like private equity groups. I don't know if this answers the question, but another way to get in is to find the deals and then bring the deal to private equity or something, and then just retain a small piece of the deal. You know, we're looking into some development stuff where I'm bringing either the deal or the LPs or the bridge financing. And I'm able to retain a small piece of equity in that deal just by bringing the opportunity to the table. So I don't know if that was the question, but that's another way to do it.
All right. Anybody else? Go ahead.
When you were mentioning assets to stay away from, you said condos. Were you speaking of the condo building or an individual unit?
The individual units. I mean, again, if you're a condo building, I mean, you're a developer. If you're going to try to buy all of them, and they usually got to piecemeal it, or you got to cut a deal with everybody. It's very difficult to do. But I was saying really to stay away from used condos because of this new Senate Bill 4D that just passed. They called the Surfside Condo Law, and it's going to require all of these old condos to have reserves before they could kind of kick the can down the road. They're going to have to deal with their problems. And the problem is that if there's no money, you got to specially assess everybody. There's one building called the Merino in Miami Beach where every unit was assessed $156,000. You know, so I mean.
You're saying the risk is as the investor that you're going to get that assessment.
Right, exactly. I mean,
That'll
you could
blow a
potentially wind
deal
up
quick.
with a big assessment that you didn't expect, and you know. You got to, you're also, when you buy in a condo, you're a partner with a bunch of other people, right? So you know, the association is made up of all the members of that association are the unit owners. You know, if you have unit owners that can't pay and can't hold up their end of the deal, you wind up in a big problem. So you know, I tend to, I stay away from condos in general because I just don't like them as an investment. But there are people that buy condos as an investment, and I would just say be very careful. Do your homework, look at the financials, the age of the building. All of these buildings are going to have to do milestone inspection reports now, especially if they're at the 25th year, and then every 10 years thereafter, they're going to have to do these SIR studies that are structural integrity reserve studies. And you know, I would say one thing is if anybody is looking to go to school and be an engineer and architect, because we're going to have a major shortage in Florida because every one of these buildings is going to need one. And I represent a few associations myself, and that's been the biggest problem is finding engineers to come out and do this work that's required under the statute. So yeah, I'd say condos is one of the things I would probably stay away from. Again, unless you know, you're dealing with a building that's a really good building, but the people in it are just scared because the market's going to crash, which, you know.
What about if you were to flip it and not hang up to it? Same risk?
Well, again, I mean, the big problem with condos, again, is insurance. A lot of insurers, they're saying, okay, wait a second, what do you have your structural report? Do you have your reserves? Oh, no, then we're not going to insure you. It's going to be, you know, big money. Fannie Mae and Freddie Mac, they're not just lending, you know, they're really looking at these issues. So when you say flip, yeah, okay, if you have somebody who's buying cash and, you know, doesn't understand what's going on right now, then maybe you'll get lucky. But otherwise, you know, yeah, flipping's fine when you have somebody that's, you know, willing to buy.
So guys, let's do one more question and then we'll break for drinks and we can ask all the questions you guys want over there. Let's do one more over there.
Speaking earlier about subject to assumptions, I wanted to know what is the best way or how do you acquire those condos?
So
What's
the
best avenue
que-
to attack those
Okay.
something like that.
So the question is on sub-2, what the sub-2 is all about and what are the different strategies to actually get started in something like this. So maybe Austin, if you want to take that.
So there, you can directly target them. You know, there's something called pre-NOD, pre-notice of default. You can get data like that, which means, so typically the foreclosure happens about 90 days after they've missed 3 payments. It's not perfect, but usually it's how it happens. But you can pull data where you get noticed on the first month, 30th day, 60th day. So you can communicate with them. You can buy that data and then market to those individuals. To say, hey, you know, do you want to, I wouldn't say like, hey, I know you're going to foreclosure. Like, don't go with that. I did probate and, you know, that's a awkward conversation, and divorce, very awkward conversation.
Sorry for your loss.
Yeah. Or, hey, by the
Do you want to sell
way,
your house?
you're getting a divorce next week. Your husband just filed. Very weird conversations. So I wouldn't lead with that. Just say, hey, do you want to sell? But as far as like, how do you do it? There's definitely documentation you need. So you need power of attorney. You got to vet and make sure you got to get a payoff. You got to get their mortgage statement to make sure that what they're telling you is actually accurate. Because if they say they owe 100, but they actually owe 2, and you don't verify that, or if you say, you know, they have a 3% interest rate, they don't tell you that it's adjustable, you know, 6 months from now, all that can be found out on the mortgage statement. But market to these individuals specifically, you know, through foreclosures or pre-NODs, or just talking to people in general. Like, you know, we've talked to sellers that, you know, just want to sell. And then we convince them to either be the lender, like we'll buy it and they'll keep a PML, private money on it, or, you know, we'll buy it and keep, you know, 3% mortgage on the asset, and we're willing to pay more money if they keep the debt in place because we're getting 7% and we'd prefer to keep 3%. So you can directly market to those people, or literally anybody who wants to sell, you can ask them if they're interested and you know, either becoming the private money lender or keeping the mortgage in place.
All right, that's great. Well, first of all, thank you guys, Michael, Austin, for
Thank you,
very
brother.
generous-
Thank you all for being here.
Again, we're very generous with your advice, information that you shared. What I like doing with all of the events that we host is bring you guys back in about a year and see if everything we've discussed still makes sense, still applies. And all of you guys, thanks so much for your time and all of the great questions. And, you know, don't go anywhere. There's plenty of drinks and foods, and let's network and let's collaborate. And just before you guys go, let's take a quick picture.
Let's do it.